Okay, and welcome back traders. I'm Lance Beggs from yourtradingcoach.com. Today we're going to look at another of the single candle reversal patterns, the inverted hammer. This pattern should be very easy to understand. If you'd followed through the whole series of videos so far, you should recall that previously we discussed a bearish reversal pattern at the top of a trend, the shooting star. And we followed that up with another bearish reversal pattern, the hanging man, which looked the same but was upside down. Well, this is the same deal. In video 7 we discussed the hammer, a bullish reversal pattern at the bottom of a downtrend. Today we discuss the inverted hammer, which is simply an upside down hammer. How easy is this stuff? So the inverted hammer is a bullish, single candle reversal pattern. Like the other single candle reversal patterns we've covered so far, the real body of an inverted hammer can be either colour, red or green, or black or white depending on your charting platform. The green body though is slightly more bullish than the red body, and I'll demonstrate that shortly when we discuss the psychology or sentiment of the pattern. The upper shadow is at least 2 times the size of the real body, and ideally there's no shadow below the candle. However, a very small shadow can be acceptable. And as mentioned at the start of the video, the trend leading into an inverted hammer must be a downtrend. If you don't have a downtrend, then it's not a valid pattern. And ideally, if we're sticking again with strict textbook definitions, we'll see a gap down from the close of the preceding candle to the open of the inverted hammer. Note, however, that the shadow out the top of the candle may be closing that gap, so it may not be immediately obvious. Confirmation of the trade will be price trading above the candlestick pattern. In some markets, such as stocks, price can very quickly turn and fall from a market top, but is often a lot slower to turn at market bottoms. As such, in those markets, I would consider an inverted hammer to be a lower probability signal than the shooting star or hanging man occurring at the top. If your testing shows similar results, then you should consider seeking good confirmation of a change in price sentiment before entering long at an inverted hammer. So which of these are inverted hammers and which aren't? Well, all exist at the bottom of a downtrend. All have an upper shadow greater than 2 times the size of the real body. And all have price trading above the high of the candle. So all of them are valid inverted hammers. Let's look at this psychology of the pattern now to see who is in control, the bulls or the bears. The downtrend initially appears to continue very strongly as price gaps down at the open. At this stage, everything is looking very bearish. The bulls see value though at these low prices and enter the market, driving the price higher, back up to the highs here. Coming into the close of the candle though, the bears drive price back down to close in the lower third of the range. The bears have dominated at the close of the candle, but we are starting to see a comeback by the bulls. Consider for a second, it still looks kind of bearish at the moment, but what has to happen now for this candle to become a bullish reversal pattern? Imagine what would happen if price trades above the high of the inverted hammer here. A number of the shorts shaken by the bulls' fight back during creation of the inverted hammer will move their stops above the high in this vicinity here. So if price trades above the high, their covering trade, which is a buy, will add fuel to the bullish momentum. In addition, a number of traders standing on the sidelines will observe the inverted hammer, see price trading above the high, and also enter long, providing additional bullish support for the up move. So price trading above the high of the candle can be confirmation of an inverted hammer. Different traders will of course seek different levels of confirmation. More aggressive traders may be satisfied with price simply trading above the high. More conservative traders may seek a close above the high, or even a whole candle above the high. And once again though, although this is called a reversal pattern, it doesn't guarantee a reversal. It may reverse, it may halt the downtrend and commence a period of sideways congestion. Okay, we're dealing with probabilities. However, depending on your trading plan, this may be an opportunity to exit if you've been trading downwards trend leading up to the inverted hammer, or to enter long and change the trade of the trend if waiting, for example, for evidence of stall at an area of price support down here. So which pattern here is more bearish, the green or the red inverted hammer? Let's look at the nature of price movement within each candle. Both candles ideally gap down at the open. The bulls then come back in force and drive the price higher, and the bears then fight back to close price in the lower third of the candle. However, The red candle closes at the base of the real body, while the green candle closes higher at the top of the real body. So you can see in the example on the video that the bears were able to drive price lower in the red body, indicating greater bearish strength. So while both a red and a green inverted hammer are bullish reversal patterns, the pattern is considered slightly more bullish if it's green and slightly more bearish if it's red. Alright, let's compare the hammer and the inverted hammer. Which pattern is more bullish now? In the inverted hammer here on the right, price gapped down at the open, which is very bearish, and after the fight back by the bulls, the bears were able to push price back down again. However, in the hammer on the left, after price was driven down and then back up by the bulls, it closed the candle in the top third. There was no subsequent fight back by the bears. Typically then, a hammer is considered more bullish than an inverted hammer due to the bulls finishing this tug of war as the dominant force. As we mentioned before, the inverted hammer finished with the bears on top, and it's not until we get confirmation through price trading above the pattern that we can call this an inverted hammer and therefore a bullish reversal pattern. Let's look at two examples. Firstly, we have a daily chart of FedEx with a nice downtrend leading to not one, but two inverted hammers, one each side of the Thanksgiving Day holiday. First hammer, pause, second hammer just to be sure everyone's awake, and then a reversal to an uptrend. And for the second example, just one trading day after that last example, this time on Rider Systems daily chart, a downtrend, followed by pause, and an inverted hammer. A very small real body in this case, only around 10 cents, but that's fine, and it's led to an excellent rally. That's it for the inverted hammer. Coming up in the next video, we'll look at one final single candle pattern, the doji, and then we're on to the 2 and 3 candle patterns. I'm really looking forward to that. I hope you are too. I'm Lance Beggs from www.yourtradingcoach.com. Wishing you happy candlestick trading and many profitable inverted hammer reversal patterns.